Binance has officially admitted to commingling funds and misleading investors about their one-to-one backing. What does this mean? What is the explanation for this? And what are my thoughts on it? Let's get started. Binance, oh my gosh, Binance for so long, and this isn't to just be FUD on Binance, but it's just like, seriously, again, Binance, who's lost their auditor, okay? Their auditor bailed. For nobody knows why, okay? Well, I mean, the company officially says that, well, nobody really trusts our proof of reserves reports anyways, says the auditor. The auditor's like, so we're just gonna stop auditing Binance. Auditor for Binance disappears. What do we find out today? Oh my gosh. Apparently, Binance has acknowledged that they keep collateral for some of the tokens they issue in the same damn wallet as customer funds. Oh, okay, so let me explain that because that's a little bit tricky to envision. So let's hop on over here and just picture this for a moment, okay? Let's say you have a bucket right here, and this is customer money, okay? So that's customer money right here. And there's $100 of customer money right here. And now, let's say you print a BNB coin, okay? You print the BNB coin or whatever you print, and you print $100 of BNB coin, and you put, I don't know, $20 in there of collateral, right? Well, obviously, if you've printed $100 of Binance token and you only have 20 actual US dollars in it, this is what's known as being under collateralized. You do not have enough money to actually provide $1 for every Binance token that you've created. Now keep in mind, this is just an example, okay? I'm just making an example here. However, if you now just happen to put both of this money in the same bucket, okay? And you kind of just erase these other little buckets you have here, and you just happen to have customer money in the same bucket as where the Binance token is that you've created or the other tokens you've created, well, how much money do you have in this bucket now? Well, you actually have $100 of the Binance token, and how much collateral do you technically have for that Binance token? Well, technically, you have $100 of customer funds and the $20 of collateral you put in. So you now have $120, which actually means rather than being under collateralized, you are technically over collateralized, and you technically have $1 backing for every $1 you have issued for every single token. So they are technically speaking correct in saying, yeah, assets are backed 1-to-1. But now the jig is up. Now, fortunately, the crypto market is rising because, in my opinion, otherwise this would lead to a bank run at Binance. Binance could be getting really lucky here in that they skirted by this market crash, but this is pretty shady because really what's being acknowledged by Binance admitted to this. They admitted to having customer funds in the same bucket as collateral for their tokens. This comes after all of the other crazy and shady things that have gone on with Binance. Now, don't get me wrong. So far, Binance has survived. Binance has been that one company that's being treated as the lender of last resort. As soon as I made a video, and I'm not patting myself on the back, other people were talking about it too, but as soon as videos were made about their Seifu fund, right, their reserves fund, their insurance fund being underfunded, they filled it back up, moved some money around. They suggest that they're capable of buying out other crypto brokerages, and they make offers, but so far they haven't closed any deals yet. But they're sending this signal of strength. In my opinion, it's kind of like the emperor wears no clothes a little bit, where they're sending this signal of strength. We'll buy you, we'll buy you, we'll buy you. And when push comes to shove, they don't actually buy because they might not actually have the money, which is very similar to that CNBC interview we saw, which all the crypto fans and Binance fans who don't want to hear that their Binance token could be at risk are like, la, 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 don't want to hear it. The CNBC interview was rigged. In the CNBC interview, when CZ, the owner of Binance, was asked, hey man, Could you cover $2 billion of demand right now? He says, we'll let the attorneys answer that. Totally ices multiple questions about what's going on with reserves and collateral they actually have. All he says is money is backed 1-to-1. But now they're acknowledging that they mistakenly kept collateral of some of their tokens in the same wallet as exchange customer funds. This is supposedly a cold wallet, but this particular wallet represents a wallet that holds reserves for almost half of the 94 tokens that Binance issues. And they were all stored in a single wallet known as Binance 8. Now, Binance, again, they say customer assets and B tokens are backed 1-to-1 by locked reserves. But that doesn't work if those locked reserves are actually the customers. No segregation all of a sudden makes it very difficult to actually verify how much does Binance actually have in reserves. And I hate to say it, but to the extent that the Binance token remains, elevated to some level, in theory, when Binance mints more Binance token, they're basically printing money like the Federal Reserve. And they're able to do that as long as people believe that money is backed 1-to-1. It's kind of like the Federal Reserve. They print money, and even though we had a lot of inflation here recently, we haven't had a groundbreaking like Weimar Republic style of inflation. Don't get me wrong, there are definitely issues with fiat currency in the Federal Reserve, but people in the world still have enough trust in the US dollar to not completely destroy it. Yet, at least. There has been no currency that has survived in the history of currencies. But going back again to this issue with Binance, the fact that the same bucket that holds that customer collateral could be that same bucket that actually holds that 1-to-1 backing is pretty nerve-wracking for folks, especially since this is thought to have been that one company that was dare I say, legit. Okay, more and more issues now coming up here, so it's something to pay attention to. Now, Binance did come out and they did say that, look, all assets held on the exchange have been and continue to be backed 1-to-1. We don't know if they're playing that 1-to-1 logic like I just explained in the video here, but remember, there is no FDIC insurance at Binance. There is no SIPC insurance. CZ and Binance are under multiple investigations with the Department of Justice and multiple other institutions throughout the world. It's scary. At the same time, they mint billions of dollars of their own Binance Ether, USDC, Tether, you name it. And again, it's all supposed to be backed 1-to-1, but all of a sudden we find out that they're not, or at least that customer assets are sitting in the same spot. Apparently, it was about 40 tokens, so roughly half of the tokens that were sitting in this. Let's see if we have some more information here. Binance now argues that assets are, quote, sufficiently backed in the event of a redemption request. Okay, so now all of a sudden it looks like on one hand they're saying assets are backed 1-to-1, and now they're changing it to saying, no, assets are actually sufficiently backed. Oh, man. Obviously, after the whole FTX disaster, there's been a lot of scrutiny here. Let's see. Binance has issued more than $539 million in total of its 41B tokens that have Binance 8 as a collateral wallet, according to calculations by Bloomberg and based on Binance data from January 20th. Whilst the wallet itself holds more than $1.8 billion in related assets. Overall, Binance 8 contains more than $16.5 billion in various crypto tokens beyond those linked to B tokens. That's that over-collateralization. That means some B tokens in the wallet have far more collateral than would be necessary. For example, Binance 8 had a reserve of almost 22,700% for Origin token OGN on Monday. Binance previously acknowledged historical issues with insufficient backing for B tokens, blah, blah, blah. And basically now they're saying this has been solved by putting customer funds into the same bucket. So this is important to clarify. I'll clarify it one last time and then we'll move on. But it's important to note that let's just draw it again here, just to make it or attempt to make it as clear as possible. If you have just $1 of one of the tokens, right? And let's just call it the MK token, okay? You have $1 of collateral backing the MK token. And I've issued, I've issued maybe $10 of the MK token. Technically, I'm under collateralized, right? But if now I have customer assets of, $1 million sitting in an account, and those are customer assets, and I put them in the same bucket, well, all of a sudden it looks like I have $100,000, or I should say 100,000x the backing needed to handle collateral requirements on token MK, right? It looks like I have 100,000 times the collateral requirement. And that was actually how they ended up kind of getting exposed on this issue, is because you had crypto firms looking at this going, dude, why do you have so much collateral for some of these individual tokens? Because it's the same collateral being used, not just for those individual tokens, but also for many other tokens and customer funds, because it's all been commingled into the same bucket. Now, when you look at the entire bucket in aggregate, you're actually substantially under collateralized. And this is why they're shifting their tone a little bit, saying, well, yeah, on an individual basis, MK is backed 1-to-1, or customer assets are backed 1-to-1. But if everyone redeemed at the same time, well, we're, quote, sufficiently collateralized. I don't know. Look, between you, me, and the fence post here, I wouldn't have any of my money on exchange. I feel like that's a simple thing that folks in crypto should understand at this point, that probably in a recession is the most dangerous time to actually stake your money. Takes treasury bills at 4%, or go find a platform that offers you 3.75% or 4%, backed by FDIC or SIPC insurance at this point. Most of them actually FDIC insured. There are plenty of them. I'm not going to even mention a name because you could just Google it and there are plenty of them and you could pick your own. Just saying, big risks over here. Now we've got to talk crypto, because Bitcoin has been kicking ass lately, and it is incredible to watch what Bitcoin is doing. And there's some pretty incredible things going on in the crypto market at the same time, as Bitcoin is actually doing pretty dang well. Many of us, we've been seeing the trend broken on Bitcoin. Here's our downtrend bouncing off on the fibs. Suggestion is that Bitcoin should be able to get right back to about 28,000. Remember that last year we saw Bitcoin sit pretty heavily between 28,000. This is the week chart over here. So we're looking at 2021 actually, but even over here, in 2022, we saw Bitcoin sit a lot around 28 to 30K over here. We saw that over here. There is now the belief that Bitcoin could quickly run back to about 28,000. And this is while at the same time, we've got some wild things happening in, well, the world of crypto. Specifically, Genesis filed for bankruptcy. Apparently, the company is undergoing confidential negotiations with various creditor groups amid a quote-unquote liquidity crunch. Genesis has, or a large owner of Genesis is the digital currency group. However, so far, creditors and Genesis have failed on any kind of restructuring agreement. Genesis helped fund the Gemini Earn program, which was where Gemini would basically allow their users to stake stable coins and earn a yield on them. But because Genesis is now going essentially BK, Gemini Earn has had to freeze withdrawals, freeze redemptions, freeze payments, and it's been a big slap in the face to that part of Gemini, which has been deemed a pretty stable company in the crypto world. A lot of institutions use Gemini for the institutional custody of crypto assets. And so a lot of nervousness still happening in the crypto space, yet crypto actually overall doing decently right now. Even Ethereum is doing very, very well right now. And this is even with staking liquidity potentially coming pretty soon here. Remember that one of the big fears or FUD story around Ethereum was that when Ethereum goes through with its merge, which it did in about September of 2022, somewhere around where Ethereum was trading for roughly where it is now, 16 to 1700, the fear was that after the merge, about 6 months later, stakers would be able to open up, essentially unlock their Ethereum accounts or Ethereum coins that are staked, and that could lead to a large push of selling pressure, which could drive Ethereum to lows we haven't seen so far. Yet, what's remarkable is Ethereum so far might not end up pricing in any kind of large selling pressure, mostly because of what researchers on Wall Street say, the advent of, and I know this word sounds kind of funny, but LSDs. LSDs are deemed liquid staking derivatives, and basically think about it like Lido. So we know that Lido is an option where people can place their Ethereum into Lido and essentially get staked Ethereum. They can take loans against it. They can transact their staked Ethereum and essentially use Ethereum as they would as if they were to have sold it. And so a lot of Wall Street individuals analyzing Ethereum now suggest that maybe we won't have that large liquidation of Ethereum during sort of that lockup expiration because of LSDs. That's the liquid staking derivatives. And the liquid staking market is up to about 33%. Here, I'll remove myself from screen here for a moment. You can see that about 33% of Ethereum's holdings right now are sitting in liquid staking accounts, which reduces some of this belief that validators or those who have staked are going to dump when it becomes possible for people to liquidate out of the Ethereum 2.0 lockups. Now, we have the Shanghai update, which is EIP 4895. That's the next major initiative. That will finally end up allowing some withdrawals from Ethereum. That was supposed to come out in May. It's now expected to come out in about March. There was a lot of demand for folks to at least be able to have a little bit more liquidity, because certainly there are a lot of validators who are locked up, who aren't using LSDs, so to speak. At least not the kind we're talking about here, liquid staking derivatives, right? But Ethereum's, by the time of the merge, Ethereum had about $20 billion of staked assets, 13 million staked coins locked up. Since then, we've had about 3 million coins of Ethereum added, not taken away. People are still adding to staked Ethereum, which is really incredible because it indicates that maybe there isn't that much demand for liquidating Ethereum. And it's been really a good thing for the Ethereum protocol to see that more people are staking and locking themselves up. And now we're at 16 million coins, or about 13% of circulating supply, locked into the protocol, which is also important because the more you have locked up in Ethereum, the more secure the network is deemed to be. So we'll see. We'll see what ends up happening here. A lot of folks still a little bit nervous about what ends up happening in March, and maybe what we're seeing now is just sort of that rising tide of the crypto market moving up. However, if you kind of look at the Ethereum staking ratio compared to competitors, it's pretty low. Look at this chart here, and it'll show you that Ethereum's staking level is sitting somewhere at about 13%, whereas Cardano is sitting somewhere around 71% of individuals in Cardano is staked. 96% of people in the Binance coin are staked. Avalanche about 62%, Polkadot 45%, Polygon 39%, Tron 44%. So really, you have a very low level of Ethereum coins actually staked and potentially subject to those lockups. In English, this is a good thing that when March rolls around, maybe there won't be that massive pressure of selling or liquidating Ethereum that individuals had been fearful of, especially since when you look at the total value locked on Ethereum contracts, which is different from percent staked, we actually haven't seen it plummet. Look at it here. Total value locked into smart contracts via Ethereum, 68%, which is the same as what we saw in 2021. Actually really incredibly bullish for Ethereum. And to some extent, the larger portion of the crypto market, right? Ethereum and Bitcoin, pretty incredible. Now, some other things that are pretty incredible are what I call crypto disasters, like what you had with Sam Bankman-Fried. Apparently, and this is quite remarkable, but apparently 1/3 of all members of Congress actually received some kind of money from FTX via donations or whatever. Now, that's pretty scary. In fact, here is that article from CoinDesk. When we go through that CoinDesk piece, we can see more than 1 in 3 of the 535 senators and representatives have received some kind of campaign support from FTX. I mean, this guy showered politicians with money. CoinDesk apparently identified 196 members of Congress, the new Congress, who had their campaigns funded by FTX. Here's a representative from California, Lou Carrera, who was among dozens of current or incoming members of Congress who took FTX contributions, in this case, $2,900, the full limit, directly from Sam Bankman-Fried himself. He said that he didn't know the gentleman, never talked to him, and decided to, or at least intends to, donate that money to the university system, the California State University system, to support their Dreamer Education Fund. Now, what's crazy about that is if they do that, basically all these charitable contributions are at risk of having their money clawed back through the FTX bankruptcy as individuals seek to recover losses at FTX. Now, even though Sam Bankman-Fried has told us his net worth is only about a paltry $100,000, somehow about $700 million of money that FTX had their hands on has been I should say seized by the Department of Justice. Now, that's kind of interesting because how can they seize $700 million from somebody who only has $100,000? Well, Reuters broke this down. Reuters suggested that $525 million of that seized money came from Robinhood shares that were seized. And then various other money came from money deposited, like $7 million deposited at Silvergate accounts associated with Sam Bankman-Fried and FTX, $94.5 million in cash from an account at Silvergate Bank, which was associated with the FTX Digital Markets Fund, and $50 million taken from other places. Even Elon Musk laughed at the idea that he only had $100,000. You could see that laughing right here. Only $100,000 left. Elon Musk laughing emojis here. It is kind of incredible that this individual has had complete access to the internet, and we've seen a lot of movement at Alameda accounts or Alameda associated accounts since his release back in December from custody. And it really goes to show how deep of a fraud this individual truly is. It's quite disgusting. However, through these liquidations, there have become some issues. For example, some money was attempted to be liquidated by some of the court-appointed liquidators, and apparently they screwed up. And some of the liquidators ran into a margin call when they withdrew too much money from certain wrapped Bitcoin funds. Apparently, 4 wrapped Bitcoins were liquidated when the Alameda liquidators took too much money out of Aave, in which case they were margin called and suffered a loss of $72,000 at current prices. So in other words, Alameda liquidators went into Aave, took the money out of Aave without realizing that money was actually collateral for debt, and ended up suffering a margin call and lost somewhere around $74,000 for doing so, which is kind of remarkable that the liquidators themselves for Alameda are getting liquidated. You just can't make this stuff up these days. It's pretty remarkable. So at the same time as all of this insanity is happening, the Genesis bankruptcy, these crazy liquidations at Alameda, the seizing of assets by the Justice Department, fear over Ethereum's lockup expiration, so to speak, Bitcoin and Ethereum are actually doing quite dang well. It's pretty remarkable.